The information provided in this video is for educational and entertainment purposes only and does not constitute professional financial, career, or investment advice. While we strive to provide accurate and up-to-date information, the financial industry is subject to rapid changes in regulations, market conditions, and hiring trends. Any career paths, salary data, or potential outcomes discussed are based on historical trends and public data, and are not indicative of future results for any specific individual. Choosing a career involves significant personal and financial risk. Viewers are strongly encouraged to conduct their own due diligence, consult with certified career counselors or financial professionals, and verify all information independently before making any life-altering decisions. We are not responsible for any actions taken based on the content of this video. Most people entering the workforce today are operating on a fundamental lie that was sold to them by the previous generation. You were likely told that a college degree is a golden ticket, that any stable job is a good job, and that if you just work hard, the money will eventually follow. But look at the data coming out of the United States labor market right now. We are seeing a massive bifurcation in the economy. While some sectors are stagnating or being replaced by automation, others are experiencing a desperate talent shortage that has driven entry-level compensation packages into the six-figure range. The reality is that the traditional path to a comfortable middle-class life is effectively broken. But for those who understand how to navigate the modern financial landscape, the opportunities are more significant than they have ever been in human history. We are currently witnessing a shift where a 23-year-old with the right technical skills and a foundational understanding of capital markets can out-earn a seasoned professional with 20 years of experience in a legacy industry. The question isn't whether the money is there. The question is whether you are positioned to catch the wave or be crushed by it. This video is designed to be a definitive masterclass on the current state of the U.S. financial job market. We aren't here to talk about generic advice you can find in a blog post from 2015. We are diving deep into the top 5 in-demand finance careers specifically for beginners in the United States. We will break down exactly why these roles are exploding, the specific skill sets the biggest firms on Wall Street and in Silicon Valley are hunting for, and the historical trends that suggest these paths will remain resilient even in the face of economic volatility. By the time we finish this deep dive, you will have a comprehensive roadmap for navigating the entry-level landscape, understanding the nuance of different firm cultures, and identifying which specific niche aligns with your cognitive strengths and long-term lifestyle goals. This is about solving the problem of career stagnation before it even begins. It is about moving you from a position of uncertainty to a position of strategic advantage. To understand why these 5 specific roles have become the vanguard of the American economy, we have to look at the structural changes in how money moves. Historically, finance was a gatekeeper industry. It was about who you knew and which Ivy League school you attended. While those connections still exist, the industry has undergone a massive democratizing shift driven by data and technology. Today, firms are less interested in your pedigree and more interested in your ability to process complex information, manage risk, and provide clarity in an increasingly chaotic global market. This shift has created an unprecedented opening for beginners who are willing to put in the work to master the technical aspects of the trade. Consider the current state of the U.S. economy. We are dealing with a unique intersection of high interest rates, a transition towards sustainable energy investments, and the integration of artificial intelligence into every facet of asset management. This creates a vacuum. Older professionals who spent their careers using legacy systems are often struggling to adapt, while the younger generation is uniquely positioned to bridge the gap. We are seeing a historical trend where firms are willing to pay a premium for digital natives who can speak the language of finance while operating the tools of the future. This is the core problem we are solving today. How to identify these high-leverage entry points so you aren't wasting the first 5 years of your career in a dead-end back-office role that will be automated out of existence by 2030. We will begin by examining the role of the investment banking analyst, which remains the quintessential starting point for high achievers, but we will look at it through a modern lens. We will explore how the shift from traditional mergers and acquisitions toward tech-focused boutique firms has changed the entry requirements. Then, we will move into the world of corporate finance, specifically looking at financial planning and analysis, or FP&A. This is a role that has moved from being a simple accounting function to becoming the strategic engine of the modern American corporation. We will look at case studies of how FP&A teams have navigated recent inflationary periods to keep major companies afloat. Next, we will pivot to the booming sector of wealth management. With the greatest transfer of wealth in history currently underway as the baby boomer generation passes down assets to millennials and Gen Z, the need for skilled, empathetic, and technologically savvy advisors is at an all-time high. We will discuss the specific certifications like the CFP that are becoming the new gold standard for entry-level success in this field. Following that, we will dive into the niche but highly lucrative world of risk management and compliance. In an era of increased government oversight and complex global sanctions, the people who can ensure a firm stays on the right side of the law are becoming some of the most protected and well-compensated employees in the building. Finally, we will analyze the rise of the fintech analyst. This is where finance meets software engineering. We will explore why this hybrid role is currently one of the most in-demand positions in hubs like New York City, Charlotte, and San Francisco. This isn't just about knowing how to balance a spreadsheet. It is about understanding how APIs, blockchain, and machine learning are redefining the very concept of a bank. This deep dive is not a surface-level overview. We are going to look at the actual day-to-day tasks you will be expected to perform in these roles. We will talk about the grueling 80-hour weeks of investment banking versus the more balanced 40 to 50-hour weeks of corporate finance. We will look at the compensation structures, moving past just the base salary to understand how bonuses, equity grants, and long-term incentives work in the American context. We are providing you with the data-driven insights you need to make an informed choice. This is your foundation. This is your masterclass. Let us begin by breaking down the specific economic forces that have made these 5 roles the most resilient and high-potential starting points for anyone looking to build a career in the United States today. We are starting with the powerhouse that sets the pace for the entire industry. The investment banking analyst position remains the foundational pillar of the American financial system. In 2026, the role has evolved from being a simple spreadsheet gatekeeper to becoming a high-velocity data architect. To understand why this career is so in demand, we have to look at the sheer volume of capital waiting to be deployed. As of early 2026, private equity firms in the United States are sitting on record-breaking amounts of dry powder, unallocated capital that must be invested to generate returns. This creates a massive demand for the people who facilitate these transactions, the investment banking analysts. Let us break down the compensation reality for a beginner entering this field today. Historical trends from the early 2020s showed entry-level base salaries hovering around $85,000 to $100,000. Fast forward to the current 2026 landscape, and we see that major bulge bracket firms like Goldman Sachs and JP Chase have pushed base salaries for first-year analysts to a range of $110,000 to $125,000. But the base is only the beginning. When you factor in performance-based bonuses, which typically range from 50% to 100% of the base salary depending on the deal flow and individual performance, a 22-year-old in New York or San Francisco is looking at a total compensation package between $175,000 and $220,000 in their first year. Imagine a character named Jordan, a recent graduate in 2026. Jordan isn't just crunching numbers. They are operating at the center of a massive technological shift. Jordan's firm is advising a mid-sized healthcare technology company on a $2 billion acquisition. In the past, an analyst like Jordan would spend 3 days manually pulling comparable company data from SEC filings. Today, Jordan uses AI-augmented platforms to aggregate and normalize that data in minutes, allowing them to spend their time on higher-level tasks, interpreting the why behind the numbers and stress-testing the assumptions in the valuation model. The core of the investment banking analyst's work revolves around 3 primary pillars: valuation, pitching, and execution. Valuation is where the technical mastery happens. As an entry-level professional, you are expected to be an expert in several methodologies. First, there is the discounted cash flow, DCF, analysis. This involves projecting a company's free cash flows over a 5 to 10-year period and discounting them back to their present value, using a weighted average cost of capital, WACC. In 2026, with interest rates remaining stickier than in previous decades, the precision required in calculating the terminal value and the discount rate is higher than ever. A mistake of 50 basis points in a discount rate can swing a valuation by hundreds of millions of dollars. Second, you have comparable company analysis, or comps. This requires identifying a peer group of publicly traded companies and comparing their trading multiples, such as enterprise value to EBITDA or price to earnings. As an analyst, you are responsible for ensuring these peers are truly comparable, matching them not just by industry but by growth profile, margin structure, and geographic exposure. The second pillar, pitching, is about storytelling. Investment banks are essentially high-end sales organizations. When a company wants to raise capital or sell itself, they pitch several banks to lead the deal. The analyst's job is to create the pitch book, a comprehensive PowerPoint presentation that outlines the bank's view on the market, the company's strategic positioning, and the potential outcomes of a transaction. This requires an obsession with detail. In the high-stakes world of 2026 finance, a single typo or a misaligned chart in a pitch book can signal a lack of professional rigor that costs the firm a multi-million-dollar fee. Finally, there is execution. Once a mandate is won, the analyst becomes the quarterback of the due diligence process. You are the one managing the virtual data room, VDR, coordinating with lawyers, accountants, and consultants to ensure every piece of financial information is verified. You are tracking the buy-side interest, managing the teaser documents, and helping draft the Confidential Information Memorandum, CIM, the massive document that tells the company's full story to potential investors. However, the historical trend of long hours remains a reality. A typical day for an analyst like Jordan might start at 9 a.m. with a team meeting to discuss the status of active deals. By 11 a.m., Jordan is deep in an Excel model adjusting assumptions for a cross-border merger. Lunch is eaten at the desk. The afternoon is spent on calls with the client's CFO, clarifying line items on the balance sheet. By 7 p.m., while much of the city is heading home, the senior bankers are providing comments on a pitch book due the next morning. Jordan will spend the next 6 hours refining slides, updating the valuation based on the latest market close, and ensuring every footnote is accurate. It is common for analysts to leave the office at midnight or 1 a.m., only to return a few hours later. Why would anyone subject themselves to this? The answer lies in the exit opportunities. Historically, 2 years as an investment banking analyst is considered the most prestigious finishing school in the business world. After 24 months of this intensity, these professionals are often headhunted by private equity firms, hedge funds, or corporate development teams at major tech companies. The learning curve is so steep that 1 year in banking is arguably equivalent to 3 years in any other finance role. You aren't just learning how to use Excel. You are learning how to operate under extreme pressure, how to manage complex projects with dozens of stakeholders, and how to think like an owner of a multi-billion-dollar enterprise. In 2026, we are also seeing a shift in what recruiters look for. While a degree from a top-tier university is still an advantage, the industry is moving toward skills-based hiring. Firms are now using technical assessments and live case studies to filter candidates. They want to see that you can build a 3-statement model from scratch, that you understand the impact of recent tax code changes on corporate earnings, and that you have the soft skills to communicate complex ideas to a CEO. Case studies show that the most successful beginners in 2026 are those who possess AI literacy. This doesn't mean you need to be a coder. It means you understand how to use large language models and specialized financial AI to automate the drudge work. If you can use a tool to automate the formatting of a 100-page presentation, you have more time to think about the strategic rationale of the deal. This makes you more valuable to the senior directors, which leads to better performance ratings and higher bonuses. The investment banking path is the ultimate high-risk, high-reward entry point. It requires a level of stamina and dedication that most people simply do not possess. But for those who can endure the grind, the financial and professional rewards are unparalleled in the United States economy. It is the engine of the financial world, and it sets the standard for every other career we will discuss in this series. But what if you want the high compensation and strategic impact without the 100-hour work weeks? What if you want to be on the other side of the table, the one actually running the company and making the long-term decisions rather than just advising on them? This brings us to a career path that has quietly become the most vital organ of the modern American corporation, a role where you are the strategic right hand of the CFO, and where your ability to predict the future is the only thing standing between a company's success and its bankruptcy. In the next part, we are moving from the high-pressure world of Wall Street advisory into the strategic heart of corporate America. We will dive into the role of corporate financial planning and analysis, the career that offers a unique blend of high pay, work-life balance, and massive organizational influence. You will see how a beginner in 2026 can go from a junior analyst to a director-level strategist in half the time it took a decade ago. But first, we have to look at the one specific skill that differentiates a middle manager from a future C-suite executive in this field. That specific skill is the ability to translate raw data into a strategic narrative, and it is the absolute core of our second in-demand career, corporate financial planning and analysis, or FP&A. While the investment bankers are busy facilitating the movement of capital between companies, the FP&A team is the one living inside the machine, deciding how every dollar of a company's revenue is reinvested, saved, or distributed. In 2026, the FP&A analyst is no longer just the budget person. They have become the internal consultants of the corporate world. Imagine a character named Sarah. She graduated from a state university in the Midwest in 2025 and is now working as a junior FP&A analyst for a major retail corporation based in Chicago. In a traditional 20th century model, Sarah's job would have been mostly retrospective. She would have spent her weeks looking at what happened last month, comparing it to the budget, and writing a report explaining the variance. But in the hypervolatile market of 2026, Sarah's role is entirely prospective. She is helping the company navigate real-time supply chain disruptions and shifting consumer sentiment using predictive modeling. Let's look at the compensation data for this path. Historically, corporate finance offered a lower entry-level salary than investment banking, but it came with a significant lifestyle premium. In 2026, the gap is narrowing as companies realize they are in a war for talent against Wall Street. An entry-level FP&A analyst in a major U.S. hub can expect a base salary between $75,000 and $95,000, with a performance bonus of 10% to 20%. While the total cash compensation of roughly $90,000 to $115,000 is lower than banking, the hourly rate is often higher. Sarah works 45 to 50 hours a week, rarely works weekends, and has a clear path to a senior analyst role within 2 years, which often breaks the $130,000 total compensation mark. The day-to-day work of an FP&A professional revolves around the annual operating plan and the monthly forecast. But don't let those terms bore you. They are the high-stakes blueprints of the company. A case study in this field would be how a tech firm in 2026 manages its transition from a subscription-based model to a consumption-based AI model. Sarah wouldn't just be counting the revenue. She would be building a multivariable sensitivity model to answer a critical question. If our cloud compute costs increase by 15% due to high demand periods, but our user retention stays flat, what is the exact impact on our EBITDA margins by Q4? To do this, Sarah uses three-statement modeling, the integration of the income statement, balance sheet, and cash flow statement. This is a foundational skill for any finance beginner. If the company decides to hire 500 new engineers, Sarah has to model out the fully burdened cost of those employees, salaries, benefits, payroll taxes, and overhead, and show exactly how that drains the cash balance over the next 18 months. She then has to present these potential outcomes to the department heads. This is where the narrative skill comes in. She isn't just showing a spreadsheet, she is telling the head of engineering, if we hire these 500 people now, we will run out of cash for our marketing expansion by next summer, unless we hit a 20% growth target in our enterprise segment. Another critical pillar of FP&A in 2026 is capital allocation. Every major corporation has a limited amount of capital to spend on CapEx or capital expenditures. Should the company build a new distribution center in Texas, or should they invest that money into a new software platform? The FP&A team runs the net present value, NPV, and internal rate of return IRR calculations on these projects. They are the objective referees who decide which projects get funded and which get scrapped. For a beginner, being the person who runs the numbers on a $50 million investment project provides a level of visibility to senior leadership that is hard to find in any other department. The career trajectory in FP&A is remarkably structured. You start as a junior analyst, move to senior analyst, then manager, director, and eventually VP of finance or CFO. Unlike banking, where the up or out pressure is intense, FP&A allows for a more sustainable growth curve. Historical trends show that many of the most successful CFOs in the Fortune 500 didn't come from a banking background. They rose through the ranks of FP&A because they understood the operational heart of the business. They knew how the inventory moved, how the sales teams were incentivized, and where the fat was in the budget. In 2026, the technical stack for FP&A has evolved. While Excel is still the king, beginners are now expected to be proficient in EPM, or enterprise performance management software like Anaplan, Workday Adaptive Planning, or Oracle Hyperion. They are also increasingly using data visualization tools like Tableau or Power BI to create executive dashboards. Imagine if Sarah can create a real-time dashboard that allows the CEO to see the company's daily cash position on their phone. That level of value add makes Sarah indispensable. Step by step, how do you break into this in 2026? First, you need the technical foundation. You must master the three-statement model. You need to understand how a change in days sales outstanding on the balance sheet flows through to the cash from operations on the cash flow statement. Second, you should aim for internships in the finance departments of mid to large cap companies. Unlike banking, which has a very rigid recruiting window, corporate finance firms recruit year-round. Third, consider the CMA, Certified Management Accountant, or even the first level of the CFA to signal your commitment to the craft. But there is a specific subsector of corporate finance that is currently seeing a massive surge in the US market: operational finance. This is where you are embedded directly within a specific business unit like sales or manufacturing. You aren't in the corporate headquarters. You are on the front lines. You are helping the sales VP design commission structures that maximize profit, not just volume. This hybrid of finance and operations is where the highest demand for beginners currently exists, because it requires someone who can speak finance to the CFO and business to the general manager. The potential outcomes for someone starting in FP&A today are vast. You aren't just a number cruncher. You are a future business leader. You are learning the language of value creation from the inside out. You see the mistakes companies make when they have too much cash, and the desperate moves they make when they have too little. This inside look is a masterclass in business strategy that you are being paid to attend. However, as vital as FP&A is to the internal health of a company, there is another career path that is currently undergoing a radical transformation due to a massive demographic shift in the United States. While Sarah is focused on the balance sheet of a corporation, there is another professional who is focused on the balance sheets of millions of American families. It is a field that was once seen as a sales job, but has now become one of the most intellectually demanding and high-earning paths for a beginner who possesses a unique blend of analytical prowess and psychological insight. In the next part, we are going to dive into the world of private wealth management and financial planning. We will explore why the great wealth transfer, the movement of over $80 trillion from older generations to younger ones, has created a talent vacuum in the advisory space. You will see how a beginner in 2026 can build a book of business that generates recurring income while providing a level of job security that is virtually unheard of in other finance roles. But there is a catch. The old way of being a stockbroker is dead. To succeed in 2026, you have to master a completely different set of tools, starting with the psychology of the modern investor. The shift in the United States financial landscape has fundamentally altered the role of the advisor. We have moved from a transactional model to a relational one. In the past, a stockbroker would call you to pitch a specific ticker symbol. In 2026, that model has been completely automated by low-cost robo-advisors and sophisticated AI trading algorithms. If your only value is picking stocks, you are obsolete. The modern financial advisor or wealth management associate is now a behavioral coach, a tax strategist, and an estate coordinator all rolled into one. This is the third in-demand career on our list, and for a beginner, it offers a path to entrepreneurship and high income that few other sectors can match. To understand the demand, we have to look at the great wealth transfer. Historical trends indicate that between now and 2045, approximately $84 trillion will pass from older generations to younger ones in the US alone. This is not just a transfer of cash. It is a transfer of responsibility. The heirs to this wealth, millennials and Gen Z, have vastly different expectations than their parents. They value transparency, socially responsible investing, and digital-first communication. They are looking for advisors who understand their unique challenges, from managing high student loan debt while buying a first home to navigating the complexities of the gig economy and equity-based compensation. Imagine a character named Marcus. Marcus is 24 years old and works as a wealth management associate at a major firm in Charlotte, North Carolina. Marcus didn't spend his day cold calling names out of a phone book. Instead, his morning began with a video consultation with a young couple who just inherited a significant portfolio of legacy stocks. Their problem isn't just about the money. It's about the tax implications of liquidating those positions and the emotional weight of managing their parents' legacy. Marcus uses sophisticated financial planning software to run simulations. He shows them 3 potential outcomes based on different withdrawal rates and tax-efficient strategies. He isn't selling a product, he is selling a roadmap. Let's talk numbers because the compensation structure in wealth management is unique. For a beginner in 2026, the initial base salary at a large firm like Morgan Stanley, Merrill Lynch, or a high-end registered investment advisor, RIA, typically ranges from $65,000 to $85,000. However, this is often a draw, or a base intended to support you while you build your own client base. The real power of this career lies in the assets under management, AUM model. Historically, firms charge a fee, often around 1%, on the total assets they manage for a client. As an associate, you typically earn a percentage of that fee. If you eventually manage $100 million in assets, that generates $1 million in annual revenue for the firm, a significant portion of which goes directly to you as recurring income. In 2026, we are seeing successful advisors in their late 20s reaching total compensation levels of $200,000 to $300,000 by focusing on niche markets, such as tech professionals with ISOs and RSU packages. The day-to-day work for a beginner like Marcus involves a deep dive into comprehensive financial planning. This is a multi-step process. First comes data gathering. Marcus has to collect every piece of a client's financial life, tax returns, insurance policies, bank statements, and retirement account details. Second is the analysis. This is where Marcus uses his technical skills to identify gaps. Are the clients overexposed to a single sector? Are they paying too much in investment fees? Do they have adequate disability insurance? In 2026, this analysis is augmented by AI tools that can scan thousands of pages of documents in seconds to find hidden risks. The third step is implementation. This is where the advisor helps the client actually move the money, opening accounts, setting up automatic contributions, and rebalancing portfolios. But the most critical part, and the reason this role is so in demand, is the fourth step, monitoring and behavioral coaching. When the market experiences a 10% correction, as historical data shows happens frequently, the advisor is the one who prevents the client from making the catastrophic mistake of selling at the bottom. This behavioral alpha is the most valuable product an advisor offers. For a beginner looking to enter this field in 2026, the gold standard is the Certified Financial Planner, CFP, designation. While the CFA is king in investment banking, the CFP is the mandatory credential for high-end wealth management. It requires mastering 6 core areas: professional conduct and regulation, general principles of financial planning, risk management and insurance planning, investment planning, tax planning, retirement savings and income planning, and estate planning. Step by step, the path involves completing a board-registered education program, passing a rigorous 10-hour exam, and completing 6,000 hours of professional experience. Another major trend we are seeing in 2026 is the rise of the fee-only RIA. Unlike traditional broker-dealers who might earn commissions on the products they sell, fee-only advisors are fiduciaries, meaning they are legally required to act in the client's best interest at all times. This model is exploding in popularity because it aligns the advisor's incentives with the client's success. For a beginner, starting your career at a fee-only RIA often provides a more ethical and sustainable foundation than the high-pressure sales environments of the past. But it isn't just about the soft skills. To succeed in 2026 wealth management, you must be a technical expert in tax loss harvesting and location-optimized investing. You need to understand how to move assets between taxable accounts, traditional IRAs, and Roth IRAs to minimize the tax drag on a portfolio over several decades. Case studies of successful firms show that providing tax alpha can add as much as 1% to 2% to a client's annual net return, which over 30 years can result in hundreds of thousands of dollars in additional wealth. Marcus's career is built on the reality that while information is free, wisdom is scarce. Anyone can look up a stock price on their phone, but very few people can build a multi-generational estate plan that survives market cycles and family disputes. The demand for this level of guidance is higher than it has ever been, specifically in the United States, where the retirement system has shifted the burden of saving and investing almost entirely onto the individual. This career offers a unique blend of financial complexity and human connection. You are there for the births, the deaths, the weddings, and the retirements. You see the raw reality of how people handle money, and you have the power to change the trajectory of an entire family's future. It is a position of immense trust and responsibility. However, as we look at the broader financial landscape, there is a massive sector that operates behind the scenes, ensuring that the entire global economy doesn't grind to a halt. While Marcus is helping individuals and Sarah is helping corporations, There is a whole different class of professionals focused on the DNA of financial transactions. They are the ones who manage the risks that nobody else sees coming. They are the guardians of the system, and in an era of global instability and complex regulations, they have become some of the most sought-after experts in the country. In the next part, we are going to explore the world of risk management and compliance. We will look at why the defensive player is often the most important person on the field. You will see how a beginner can enter this space and quickly become a high-level strategist, protecting multi-billion-dollar firms from cyber threats, regulatory crackdowns, and systemic failures. But there is a specific type of risk that is currently keeping every CEO in America awake at night. And if you are the one who knows how to mitigate it, your career potential is virtually limitless. That specific risk is systemic operational failure, and the professionals charged with preventing it are risk management and compliance officers. In the United States financial ecosystem of 2026, these are no longer back-office administrative roles. They have been elevated to the middle office and front office strategic layers. As global financial regulations become more granular, and the speed of capital movement approaches near instantaneous levels, the margin for error has vanished. This has created a massive demand for beginners who can navigate the intersection of law, finance, and technology. Imagine a character named David. David is a 25-year-old risk analyst at a major fintech firm in Austin, Texas. While his peers in sales are focused on bringing in new users, David's entire world is focused on scenario analysis and stress testing. His job is to wake up every morning and ask, what is the one thing that could happen today that would bankrupt this firm by tomorrow? This mindset is the core of the risk profession. In 2026, David is specifically looking at liquidity risk, the risk that the firm won't have enough cash on hand to meet its obligations during a sudden market panic. Let's dive into the compensation and career path data. Historically, risk and compliance roles were seen as the safe but slow path in finance. However, 2026 market data shows a significant shift. Entry-level risk management analysts in major financial centers like New York, Chicago, or Charlotte are starting with base salaries between $80,000 and $105,000. Compliance officers, particularly those specialized in anti-money laundering, AML, or Know Your Customer, KYC regulations, are seeing similar starting figures. When you add performance bonuses and the high demand for these specialized skills, total first-year packages often reach $120,000 to $140,000. More importantly, the job security in this sector is historically higher than in investment banking or trading. When the market goes down, firms need risk managers more than ever. The day-to-day work for a beginner in risk management revolves around four primary types of risk: market risk, credit risk, operational risk, and model risk. Market risk is about the volatility of asset prices. If you are working for an investment bank or a hedge fund, you are calculating value at risk (VAR). This is a statistical technique used to measure and quantify the level of financial risk within a firm or investment portfolio over a specific time frame. For a beginner like David, this means running thousands of Monte Carlo simulations, mathematical algorithms that model the probability of different outcomes in a process that cannot easily be predicted due to the intervention of random variables. You are trying to determine with 99% confidence the maximum amount the firm could lose in a single day. Credit risk is the risk that a borrower will default on their obligations. If you work for a commercial bank like Wells Fargo or Bank of America, you are the one analyzing the creditworthiness of corporations and individuals. You are looking at debt-to-equity ratios, interest coverage ratios, and historical payment trends. In 2026, this involves using alternative data, such as real-time supply chain data or satellite imagery of retail parking lots, to predict if a company is about to hit a cash flow crunch before it actually shows up on their official financial statements. Operational risk is perhaps the fastest-growing subsector in 2026. This is the risk of loss resulting from inadequate or failed internal processes, people and systems, or from external events. This includes everything from a massive cyber attack to a rogue trader bypassing internal controls. For a beginner, this involves process mapping, identifying every single step in a financial transaction and finding the single point of failure. Case studies of major bank failures in the early 2020s showed that most weren't caused by bad investments, but by failures in operational oversight. Compliance, on the other hand, is the art of ensuring the firm adheres to the mountainous pile of federal and state regulations. In the US, this means navigating the rules set by the SEC, FINRA, and the Federal Reserve. For a beginner, This is a deep dive into regulatory technology, or RegTech. You are helping to build and monitor automated systems that flag suspicious transactions. Imagine if a firm processes 10 million transactions a day. You are the one designing the red flag parameters that identify potential money laundering or insider trading without slowing down the legitimate business. Step by step, how does a beginner build a career here? First, you need a strong quantitative foundation. You don't need to be a mathematician, but you must be comfortable with statistics and probability. Second, you should aim for professional certifications early. The Financial Risk Manager (FRM) designation is the gold standard in risk, while the CAMS, Certified Anti-Money Laundering Specialist, is highly valued in compliance. Third, you must develop a skeptical mindset. You are essentially a financial detective. You are looking for the anomalies, the outliers, and the things that don't quite add up. A critical case study for 2026 is the cyber risk integration. We are seeing a historical trend where finance and cybersecurity are merging. A risk manager today must understand how a distributed denial of service (DDoS) attack on a clearinghouse could freeze the entire repo market. If you can speak both the language of duration gap and zero trust architecture, you are one of the most valuable employees in the United States. The potential outcomes for a beginner in this field are incredibly stable. You are building a skill set that is globally transferable and recession-proof. Every time a new financial scandal hits the headlines, the budget for risk and compliance departments increases. You are the insurance policy for the firm's leadership. When the CEO has to testify before Congress, they are relying on the data and the frameworks that you, the analyst, have provided to prove that the firm was acting responsibly and managing its risks appropriately. But there is a specific nuance to this field that many beginners overlook. It is the model risk management, MRM. As more firms rely on AI and machine learning to make trading and lending decisions, the risk that the model itself is flawed becomes a systemic threat. If the model was trained on historical data that no longer reflects the 2026 economy, its predictions will be dangerously wrong. The people who can audit these AI models, checking them for bias, drift, and logical errors, are currently commanding some of the highest salaries in the entry-level market. This role requires a unique personality. You have to be comfortable being the person who says no when everyone else wants to say yes. You have to be the one who points out the iceberg while the rest of the crew is focused on the speed of the ship. It is a career of integrity, precision, and deep strategic thinking. However, as we move through our list of the top 5 finance careers, we arrive at the most modern iteration of the industry. We have looked at the bankers, the corporate strategists, the personal advisors, and the system guardians. But what happens when you take all of these functions and move them entirely into the realm of code? What happens when the bank is no longer a building or even a website, but a series of interconnected algorithms? In the next part, we are going to explore the world of the fintech analyst. This is the intersection of high finance and Silicon Valley. We will look at why this specific role is currently experiencing the most explosive growth in the US, and how a beginner with zero coding background can still thrive in this tech-dominated space. But there is a massive shift happening in how credit is being issued in America, and if you understand this one trend, you will be 10 steps ahead of everyone else in the room. The trend that is currently reshaping the American financial landscape is the rise of embedded finance and alternative credit scoring. In 2026, the fintech analyst has become the architect of this transition. This is the 5th and arguably most dynamic in-demand career on our list. To understand the gravity of this role, you have to realize that for the last 50 years, the FICO score was the undisputed king of American credit. If you didn't have a traditional credit history, you were effectively locked out of the financial system. But fintech analysts are changing that by leveraging data that traditional banks have ignored for decades. Imagine a character named Chloe. She is 23 years old and works for a major fintech unicorn in Palo Alto, California. Chloe's job isn't to look at tax returns or bank statements in the traditional sense. Instead, she is analyzing the digital footprint of small business owners. When a florist in Ohio applies for a line of credit through a delivery app, Chloe's algorithms are looking at real-time sales data, customer review sentiment, and inventory turnover rates. This is the new credit. By the time a traditional bank would have even opened the application, Chloe's firm has already approved the loan and deposited the funds. This speed and precision are exactly why the demand for fintech analysts has exploded by over 40% in the last 3 years, according to historical labor trends. Let's break down the compensation for a beginner entering the fintech space in 2026. This is where the lines between finance and tech become blurred. Because you are competing with companies like Google and Meta for talent, the salary packages are highly competitive. An entry-level fintech analyst in a hub like San Francisco, New York, or increasingly Miami can expect a base salary between $95,000 and $120,000. But the real potential outcome of this career path lies in the equity. Unlike a traditional bank where you get a cash bonus, fintech firms often provide restricted stock units, RSUs, or stock options. In 2026, a typical first-year package might include $20,000 to $30,000 in equity that vests over 4 years. If the company goes public or is acquired, a common occurrence in this sector, that equity can represent a life-changing financial event. The day-to-day work of a fintech analyst revolves around product strategy, data analytics, and user experience, UX finance. Product strategy is where you decide what the financial product actually is. In 2026, this often involves fractionalization. Analysts are working on ways to allow everyday investors to buy fractions of high-value assets that were previously out of reach, such as commercial real estate, fine art, or even private credit funds. As a beginner, you are running the unit economics on these products. You are asking, what is the cost of customer acquisition versus the lifetime value of a user who only invests $50 a month? You are building the financial models that prove a product is viable before a single line of code is written. Data analytics is the engine room. In 2026, a fintech analyst must be proficient in SQL and at least one programming language like Python or R. You are querying massive databases to find patterns. For example, a case study in 2026 involves churn prediction. By analyzing the transaction data of millions of users, Chloe can identify the exact signal that suggests a user is about to stop using the app. Perhaps they stopped linking their primary checking account or their average transaction size dropped by 20%. Chloe then works with the marketing team to design a targeted incentive to retain that user. This is finance as a science. The third pillar is UX finance. This is a relatively new concept in 2026. It is the realization that the friction in a financial transaction is a cost. If it takes 6 clicks to send money to a friend, people won't use it. If it takes 3 clicks, they will. The fintech analyst is the one who quantifies the value of that user journey. You are calculating the conversion funnel. How many people start the application for a credit card versus how many actually finish it? If you can increase that conversion rate by just 2% through a better financial design, you are adding millions of dollars to the bottom line. A major trend within fintech that is driving demand is B2B fintech, or business to business. While consumer apps get all the headlines, the real money in 2026 is being made in the plumbing. These are firms that provide the infrastructure for other companies to offer financial services. If a grocery store wants to offer its own buy now, pay later service at the checkout, they don't build a bank. They plug into a fintech provider. Analysts in this space are managing the API economy. They are ensuring that the data flows securely and accurately between the retailer and the financial backend. Step by step, how do you position yourself for this in 2026? First, you need a hybrid education. A pure finance degree is often not enough. You should look for fintech concentrations or take boot camps in data science. Second, you must understand the regulatory sandbox in the United States. Fintech operates in a gray area between traditional banking laws and tech regulations. Understanding the basics of the Bank Secrecy Act and how it applies to digital wallets is a massive advantage. Third, you should be active in the fintech community. In 2026, hiring is heavily influenced by your presence on platforms like LinkedIn and specialized finance forums. Sharing insights on the latest trends in decentralized finance or stablecoin regulation can get you noticed by recruiters at top firms. The potential outcomes for a fintech analyst are perhaps the most diverse of all 5 careers. You could stay on the analyst track and become a head of product, or you could move into venture capital, where you use your deep understanding of unit economics to identify the next big startup. Many fintech analysts eventually become founders themselves. Because you have seen the innards of how a modern financial platform works, you are uniquely positioned to spot the gaps that still exist in the market. However, there is a specific challenge in fintech that requires a unique kind of resilience: the pivot. In the fast-moving tech world of 2026, a business model that worked in January might be obsolete by June due to a new regulation or a competitor's breakthrough. As an analyst, you have to be comfortable with throwing away your work and starting over with a new strategy. It is high-octane, high-stakes, and requires a level of mental flexibility that traditional banking rarely demands. We have now covered the Big Five: the high-pressure prestige of investment banking, the strategic influence of corporate FP&A, the relational impact of wealth management, the systemic guardianship of risk and compliance, and the innovative frontier of fintech. Each of these paths offers a distinct lifestyle, a different compensation trajectory, and a unique way to impact the United States economy. But knowing what the careers are is only half the battle. The real question is, how do you actually get the job? In a world where 2026 AI can write a resume and pass a basic finance quiz, how do you, the human candidate, stand out? How do you navigate the hidden job market, where the best roles are never even posted on a public board? And more importantly, how do you decide which of these 5 paths actually matches your specific cognitive profile? In the next part, we are going to pivot from the what to the how. We are going to go behind the scenes of the 2026 recruiting process. We will look at the 48-hour technical test that has replaced the traditional interview at top firms. We will explore the network mapping strategy that the top 1% of candidates use to get their resumes to the top of the pile. And we are going to introduce a self-diagnostic tool that will help you determine with data-driven precision which of these 5 careers you were actually built for. But first, there is a secret about internships in 2026 that most people are getting completely wrong, and it is the single biggest reason why high GPA students are being rejected. The secret about internships in 2026 is that the era of the experience collector is officially over. Historically, students believed that stacking 3 or 4 brand-name internships on a resume was the ultimate way to secure a full-time offer. However, in the current US labor market, recruiters have shifted their focus from where you work to what you actually shipped. We are seeing a historical trend where firms like Goldman Sachs, BlackRock, and even mid-market private equity shops are rejecting candidates with 4.0 GPAs from Ivy League schools because their internship experience was passive. They spent their summers shadowing, getting coffee, and observing meetings rather than owning a specific financial model or driving a piece of analysis to completion. In 2026, the high-yield internship is defined by verifiable output. Imagine a character named Ethan. Ethan is a junior at a large public university. Instead of just listing summer analyst on his resume, Ethan's internship at a boutique investment bank involved him being the primary lead on the buyer list generation for a $50 million sell-side mandate in the renewable energy space. He didn't just assist, he utilized AI-driven research tools to identify 40 strategic and financial buyers, drafted the initial teaser, and managed the initial Q&A in the data room. When Ethan interviews for a full-time role, he isn't talking about what he learned. He is talking about the deal he helped execute. This is the proof of work model that has taken over the United States finance recruiting scene. This brings us to the most significant hurdle in the 2026 hiring process: the 48-hour technical test. Gone are the days when a simple behavioral interview and a few brain teasers would land you a job. Today, once you pass the initial screening, you are handed a raw data set, perhaps the last 3 years of financial statements for a distressed retail company or a messy CSV file of a fintech's user transaction data. And you are given 48 hours to return a fully functional financial model and a 3-slide executive summary. Let's break down exactly what this test looks for step by step. First is technical accuracy. If your balance sheet doesn't balance, or if your interest expense isn't properly linked to your debt schedule, you are automatically disqualified. There is no partial credit in 2026. Second is assumption integrity. You will be asked to project revenue for the next 5 years. If you simply input a flat 5% growth rate without justifying it based on market share trends, inflationary pressures, or historical cycles, the senior associates will flag you as a passive thinker. They want to see that you researched the industry, looked at the 10K filings of competitors, and made an informed judgment. Third is presentation clarity. A complex model that no one else can read is useless. You are being judged on your Excel hygiene, using consistent color coding, blue for inputs, black for formulas, clear labeling, and a summary tab that tells the story at a glance. Case studies from 2026 recruiting cycles show that many candidates fail not because they lack the math skills, but because they fail the stress test. They panic when the data is incomplete or contradictory. In the modern US finance office, data is never perfect. The analysts who thrive are those who can make reasonable estimates, document their assumptions, and move forward. This is why many firms are now using these 48-hour tests as a proxy for how you will handle a high-pressure live deal environment. Now let's talk about the hidden job market and the strategy of network mapping. In 2026, over 70% of high-end finance roles in the US are filled before they are ever posted on LinkedIn or Indeed. If you are waiting for a job posting to appear, you are already too late. The top 1% of candidates use a technique called institutional mapping. Imagine a character named Maya who wants to break into wealth management. Maya doesn't just send out resumes. She identifies the decision makers within specific teams at 10 target firms. She uses a 3-node strategy. First, she connects with a first-year analyst to understand the actual culture and the specific technical tools the team uses. This is her intelligence gathering. Second, she reaches out to a vice president or director level, the person who actually manages the hiring process. Her message isn't a plea for a job, it is a value-add inquiry. She might send a brief, 2-paragraph analysis of a recent market trend she noticed that impacts their specific client base. Third, she maintains ambient awareness with the senior partners through high-quality commentary on their professional posts or attending industry webinars where they are speaking. By the time a role opens up on Maya's target team, the VP already knows her name and her value add. When the HR department asks for internal referrals, Maya's name is the first one that comes up. This isn't networking in the old transactional sense. It is building a professional reputation before you even have the professional title. But how do you know which of the 5 paths we discussed, investment banking, FP&A, wealth management, risk, or fintech, is the right cognitive fit for you? In 2026, we use a self-diagnostic tool based on 3 primary variables: time horizon, complexity preference, and social interaction. First, consider your time horizon. Do you crave the short burst high of a 3-month merger deal where everything is high stakes and immediate? That is the world of investment banking and certain fintech roles. Or do you prefer the long arc strategy of building a 20-year wealth plan for a family or a 5-year strategic roadmap for a corporation? That is the world of wealth management and FP&A. Second, look at your complexity preference. Some people love the logical puzzles of risk management, finding the one tiny flaw in a system that could cause a collapse. Others prefer the synthesis of fintech, where you have to balance financial logic with user experience and software constraints. If you enjoy deep focus work on a single massive spreadsheet, risk or FP&A might be your home. If you enjoy context switching between 10 different tasks a day, banking or wealth management is a better fit. Third is social interaction. Investment banking is a team sport played in a pressure cooker. Wealth management is a deeply personal, one-on-one human connection. FP&A involves navigating corporate politics and cross-departmental communication. Fintech requires collaborating with engineers and product designers who speak a completely different language than finance. Historical trends show that the biggest cause of burnout in the United States finance sector isn't the hours. It is the misalignment of cognitive profile to the role. A brilliant mathematician who hates talking to people will be miserable in wealth management, no matter how much they are paid. A high-energy social butterfly will wilt in a back-office risk management role, even if the job security is perfect. Step by step, to succeed in 2026, you must first audit yourself using these 3 variables. Then you must build your proof of work through high-yield internships or personal projects, such as a public-facing financial blog or a portfolio of models on GitHub. Finally, you must use network mapping to bypass the automated screening systems and get your work in front of the people who actually sign the offer letters. The potential outcomes for those who master this new playbook are staggering. We are seeing beginners in 2026 move from entry-level to mid-senior roles in as little as 3 years by being strategically aggressive with their career management. They aren't waiting for permission to lead. They are creating value from day one and making sure the right people see it. But even with the right role and the right strategy, there is one final boss level you have to defeat to truly reach the top of the US finance world. It is the one thing that separates the people who earn a high salary from the people who build true generational wealth within the industry. It involves understanding the difference between being labor and being capital. In the next part, we are going to dive into the equity ladder. We will explore the specific way compensation is structured in 2026, moving beyond base and bonus into the world of carry, profit interest, and phantom stock. You will see why a lower base salary in the right firm can actually lead to a net worth that is 10 times higher over a decade. But there is a massive legal trap in most employment contracts that is designed to keep you from ever seeing that money, and if you don't know how to negotiate it, you might be working for free. To understand the difference between being an employee and being a stakeholder, we must dissect the evolution of compensation in the 2026 United States financial sector. For decades, the goal for a beginner was simply to secure a high base salary. However, historical trends now show that the real wealth in finance is built through equity participation. This is the equity ladder, and understanding it is the only way to move from being labor, someone who trades their time for money, to being capital, someone whose assets generate wealth independently of their hourly output. In 2026, even entry-level roles in private equity, hedge funds, and venture-backed fintech firms are increasingly offering complex incentive structures that go far beyond a standard paycheck. Let us look at a character named Alex. Alex is 26 and has just completed 2 years in investment banking. Instead of taking a high-salary corporate role, Alex joins a middle-market private equity firm in Chicago. His base salary is actually lower than what he made as a senior analyst in banking, around $120,000. However, his contract includes something called carried interest or carry. This is the holy grail of finance compensation. Carry is a share of the profits that the firm's partners and employees receive from the successful exit of an investment. Imagine if Alex's firm buys a manufacturing company for $100 million and sells it 5 years later for $300 million. The carry is typically 20% of that $200 million profit, which is $40 million. While the lion's share goes to the senior partners, even a junior associate like Alex might have 0.5% or 1% of the carry pool allocated to them. In this scenario, a 0.5% share of that profit is $200,000. This is paid out as a lump sum upon the exit of the investment. When you multiply this across several deals in a portfolio, the potential outcomes for a junior professional can exceed their cumulative base salary by a factor of 5 or 10 over a decade. However, this is where the legal trap mentioned earlier comes into play: the vesting and forfeiture clauses. In 2026, many firms have moved toward back-ended vesting schedules. This means that while you are granted the equity or carry on day one, you don't actually own it until you have been with the firm for a specific period, often 5 to 7 years. If you leave or are let go in year 4, you might walk away with zero, effectively having worked for a below-market salary for years in exchange for a potential payout that never materialized. This is why understanding the acceleration clauses in your contract is vital. You need to know what happens to your equity if the firm is sold or if you are terminated without cause. Another critical component of the 2026 equity ladder is profit interest. Unlike stock options, which give you the right to buy shares at a certain price, profit interests are actual equity stakes that only have value if the company's value increases above a hurdle or strike price set at the time of the grant. The major advantage here, specifically for US-based professionals, is the tax treatment. Under current 2026 tax codes, if structured correctly, profit interests and carried interest are often taxed at the capital gains rate, currently significantly lower than the top marginal income tax rate. This means you aren't just earning more. You are keeping more of what you earn. Step by step, how do you negotiate these complex structures as a beginner? First, you must request a cap table summary. You need to know how much of the company or the fund you actually own. A 10,000-unit grant sounds impressive, but if there are 100 million units outstanding, your stake is negligible. Second, you must understand the liquidation preference. This is a legal term that dictates who gets paid first when a company is sold. If the investors have a 2x liquidation preference, they get double their money back before the employees see a single cent from their equity. In a market where valuations have cooled, many fintech employees in 2026 are finding that their equity is underwater because the company would need to sell for an impossibly high price for their shares to have any value. Let's examine a case study of a phantom stock plan, common in smaller, privately held wealth management firms or boutique advisory shops. Imagine a character named Sarah who joins a firm that doesn't want to give away actual ownership. They offer her phantom stock, a contractual agreement that pays her a cash bonus tied to the increase in the firm's valuation. If the firm's value grows by $10 million over 3 years, Sarah's phantom 1% stake results in a $100,000 cash payout. This provides the incentive of equity without the legal complexity of actual shares. For a beginner, this is often a safer and more transparent entry point into the equity ladder. But there is a psychological trap as well. We see a historical trend of golden handcuffs. This is when the potential payout of your vesting equity is so high that you feel unable to leave a toxic or stagnant work environment. In 2026, we are seeing a rise in secondary markets where employees of private firms can sell their vested shares to outside investors before the company goes public. Understanding how to access these markets is a key skill for the modern finance professional. It allows you to de-risk your career by taking some money off the table early. The potential outcomes of mastering the equity ladder are what separate the rich from the wealthy in the United States. If you are only focused on your salary, you are still a part of the working class, albeit a high-earning one. True wealth in finance comes from the multipliers. It comes from the deals where you have skin in the game. This is why, when choosing between two job offers, a savvy 2026 beginner will often take the one with a $20,000 lower base salary, if the equity upside and the vesting terms are superior. To navigate this, you need to develop financial literacy for the financier. You have to be able to model your own compensation package with the same rigor you apply to a client's valuation. You need to account for dilution, the process where your percentage of ownership decreases as the company issues more shares to new investors. If you start with 1% of a startup but the company goes through 3 more rounds of funding, you might end up with 0.2%. If the company's value hasn't increased 5-fold in that time, you have effectively lost money in real terms. In 2026, the smart money is also looking at co-investment opportunities. This is where a firm allows its employees to invest their own cash alongside the firm's capital in a deal, often with no management fees. This is the ultimate alignment of interests. It allows a junior analyst to benefit from the same high-level deal flow as the billionaire partners. Even an investment of $5,000 or $10,000 in a top-tier private equity deal can have historical returns that far outpace the public stock market. We have moved from the what and the how into the why. The reason these 5 careers are so in demand isn't just because they pay well. It is because they provide the best platforms in the world to access the equity ladder. Whether it is through carry in banking, profit interest in fintech, or AUM-based revenue sharing in wealth management, these roles are designed to reward those who can generate value. However, as you climb this ladder, you will realize that your technical skills and your understanding of contracts are only the foundation. There is a ceiling that every finance professional hits around year 5 or 6. To break through it, you have to transition from being a producer to being a leader. You have to master the invisible skills of the industry, the ones that are never taught in business school and certainly aren't in any HR manual. These are the skills of influence, power mapping, and crisis management. In the next part, we are going to look at the mid-career pivot. We will explore how to transition from the person doing the work to the person winning the business. We will look at the 1% skill, the ability to read a room and negotiate when the stakes are millions of dollars. You will see why the most successful people in 2026 aren't the ones with the highest IQ, but the ones with the highest political intelligence. But first, there is a specific social protocol in the top US firms that, if broken just once, can end your career before it truly begins. We are going to expose the unwritten rules of the 2026 financial elite. The social protocol of 2026 is built on a paradox: extreme accessibility combined with invisible, high-stakes gatekeeping. In the top-tier financial firms of New York, Chicago, and San Francisco, the traditional hierarchies have flattened in appearance, but they have deepened in practice. You might see a first-year analyst wearing a hoodie and eating lunch with a managing director, but do not be fooled by the casual exterior. The unwritten rules of the financial elite are more rigid than ever, and they center on a concept we call information discretion. In an era where every transaction is tracked and every communication is potentially public, the ability to protect the inner circle is the single most important social asset you possess. Imagine a character named Tyler. Tyler is a 25-year-old associate at a top-tier private equity firm. He finds himself at a high-end dinner with several senior partners and a potential acquisition target, a CEO of a major logistics company. The conversation is relaxed, seemingly revolving around sports and travel. A beginner's mistake in this situation is to try and prove their worth by interjecting with technical data or market insights out of turn. This is a violation of the first unwritten rule, the strategic silence. In these high-level social settings, your job as a junior is to be an impeccable observer, to manage the logistics of the event, and to only speak when a direct technical question is directed at you. Tyler understands that by maintaining a composed, attentive presence without needing to be the center of attention, he is signaling executive presence, the belief that he can be trusted in a room where $100 million deals are being quietly negotiated. The second unwritten rule of 2026 is the protocol of reciprocity. In the US finance world, Networking is often misunderstood as a one-way street where a junior asks a senior for a favor. Historical trends among the most successful professionals show the opposite. The elite protocol dictates that you must lead with value. This is the node-to-node value transfer. If Tyler wants a favor from a senior MD, he doesn't ask for a meeting. Instead, he spends weeks researching a niche sector that the MD is interested in and sends a brief, 3-point bulleted summary of a blind spot he discovered in the current market data. He provides intelligence first. This creates a psychological debt. In the culture of 2026, information is the currency of the elite, and if you are a source of high-quality, actionable intelligence, you are no longer an employee, you are a resource. Step by step, the social protocol involves mastering digital etiquette as well. In 2026, the ghosting of internal emails or late responses to client inquiries is viewed not as a lack of time, but as a lack of professional discipline. The rule is immediate acknowledgement. Even if you don't have the answer, a response within 15 minutes saying, "I have received this and am currently pulling the data. Expect a full update by 4 p.m., is mandatory. This builds a reliability narrative. When the partners are deciding who to staff on the most important deal of the year, they don't look for the person with the highest IQ. They look for the person whose reliability is a statistical constant. Now, let us look at the transition from producer to leader, the mid-career pivot. This usually happens between years 3 and 5. Up until this point, your value has been technical output, building models, writing reports, and cleaning data. But there is a ceiling to how much you can be paid for your own labor. To break through, you must become a revenue generator or a multiplier. This requires mastering the invisible skill of power mapping. Power mapping is the ability to look at an organization, whether it is your own firm or a client's company, and identify where the real decisions are made. Often, the person with the highest title is not the decision node. It might be a chief of staff, a longtime consultant, or a specific vice president who has the ear of the CEO. Case studies of successful rainmakers in 2026 show that they spend as much time mapping the social and political landscape of a deal as they do modeling the financials. If you can identify the internal champion for a deal and provide them with the specific data they need to win an internal argument, you have engineered a result from the shadows. This is the highest form of influence in finance. Consider a scenario where Sarah, our FP&A professional from earlier, wants to move into a director role. She identifies that the company is currently split on whether to expand into the Southeast market. Instead of just doing the math, she power maps the stakeholders. She realizes the COO is hesitant because of potential labor shortages. Sarah doesn't just send a report. She conducts a preemptive strike by gathering labor data and presenting it to the COO's most trusted advisor 2 days before the board meeting. She aligns the interests before the conflict even begins. This is political intelligence in action. The potential outcomes for those who master these protocols are a direct path to the partnership. In the United States, being a partner at a major firm is not just a job title. It is a change in legal status. You move from a W-2 employee to a K-1 partner. You are now an owner of the firm's cash flows. Historical data suggests that the socially intelligent professional reaches this level 4 to 6 years faster than the purely technical professional. In 2026, where technical tasks are being increasingly commoditized by AI, the human-to-human skills of negotiation, persuasion, and conflict resolution have become the most valuable alpha in the market. However, there is a dark side to these protocols: the culture of total availability. In 2026, the top 1% of finance firms in the US expect a level of commitment that borders on the absolute. This is the crisis management protocol. If a deal is going sideways on a Saturday night at 11 p.m., you are expected to be on the call with your laptop open, ready to run numbers. The unwritten rule is that you don't complain about the hours, you celebrate the high-stakes nature of the work. This is a social signaling mechanism. By being available in the trenches, you are proving your loyalty to the inner circle. Those who try to set rigid boundaries too early in their career often find themselves soft-locked out of the most lucrative deal teams. To survive and thrive within these protocols, you must develop a professional persona that is distinct from your personal self. You are a high-performance instrument. You manage your sleep, your health, and your social battery with the same precision you apply to a portfolio. In 2026, we see a trend of biohacking among the financial elite, not for vanity but for cognitive endurance. The person who can remain calm and analytical during hour 20 of a negotiation is the one who wins the concession. We have now explored the technical paths, the equity structures, and the social protocols. You have the blueprint for the top 5 finance careers in America. You understand the what, the how, the why, and the who. But there is one final piece of the puzzle. It is the end game. What happens when you have reached the top? What is the ultimate potential outcome? For a beginner starting today in 2026, it isn't just about a high net worth or a prestigious title. It is about financial sovereignty, the ability to use your expertise to exit the rat race entirely and become a market mover in your own right. In the final part of this masterclass, we are going to look at the 10-year exit strategy. We will show you how to take the skills and the capital you have built in these 5 careers and transition into personal private equity and angel investing. We will look at the wealth life cycle and how to ensure that you don't just earn a lot of money, but that you keep and grow it across generations. But first, there is one final warning. In the next 3 years, there is a specific macroeconomic shift coming to the United States that will destroy 2 of these 5 career paths, while making the other 3 even more lucrative. If you are on the wrong side of this shift, all your hard work will be for nothing. We are going to reveal the survival map for the 2027 to 2030 economy. The shift that is currently materializing in the United States economy, as we move deeper into 2026, is the transition from a growth-at-all-costs environment to a capital efficiency environment. Between 2027 and 2030, we anticipate a period where the cost of capital remains structurally higher than the 2010s average. This is the survival map you must understand to protect your career. In this high-rate, high-volatility era, roles that rely purely on transaction volume, such as certain high-frequency trading or low-tier mortgage brokerage roles, are at significant risk of contraction. However, the top 5 we have discussed are specifically insulated because they are structural careers. They solve fundamental problems that actually become more acute during economic stress. To navigate the 2027 to 2030 economy, you must focus on the 10-year exit strategy. This is the process of taking the specialized knowledge you have gained in your first decade and turning it into personal private equity. Imagine a character named David. David spent his first 7 years in corporate FP&A and risk management. By 2026, he has reached the level of director. But David isn't just collecting a salary. He has spent years building a thesis. He understands exactly why mid-sized manufacturing firms in the American Midwest are struggling with their digital transformation. Because he has the proof of work and the network map we discussed earlier, David doesn't just stay an employee. He identifies a distressed but fundamentally sound company, partners with a few high-net-worth individuals he met during his career, and executes a search fund acquisition. David is no longer managing a budget for someone else. He is the owner-operator of a multi-million-dollar asset. This is the ultimate potential outcome of the finance path. Let's break down the wealth life cycle that leads to this level of sovereignty. Historical trends show that the most successful financiers follow a 3-stage process. Stage 1 is high-intensity accumulation. This is your first 5 years, the years of the 80-hour weeks in investment banking or the grueling technical tests in fintech. During this stage, your saving rate is your most important metric. Case studies of successful 2026 professionals show that they resist lifestyle creep. Even as their total compensation jumps from $100,000 to $250,000, they maintain the expenses of someone earning $70,000. They are buying their freedom with every dollar they don't spend on a luxury car or a high-rise apartment. Stage 2 is strategic deployment. Between years 5 and 10, you move your capital and your time into multipliers. This is where you leverage the equity ladder we explored in Part 8. You aren't just saving cash. You are accumulating carry, profit interests, and co-investment stakes. By 2026, the power of compounding on these equity positions often begins to outpace your annual salary. This is the moment where financial sovereignty becomes a statistical reality. You are no longer working because you have to. You are working because you are building a legacy. Stage 3 is the exit and the pivot. By year 10, you have the 3 things necessary to move into personal private equity: a massive technical skill set, a network of capital nodes, and enough personal liquidity to take calculated risks. In the 2027 to 2030 survival map, the people who thrive are the ones who can arbitrage their skills. If you know how to value a company better than anyone else, and you have the capital to buy a stake in one, You are no longer at the mercy of the job market. You are the market. However, to get there, you must avoid the final boss of the finance world, the compliance of the soul. This is a psychological trap where professionals become so accustomed to the high-pressure, high-status world of elite finance that they lose the ability to think independently. They become careerists who are afraid to take the leap into ownership because they might lose their title or their predictable bonus. In 2026, we see a historical trend where the most talented people are leaving the bulge bracket firms earlier than ever to start their own microfunds or fintech labs. They realize that the real risk isn't leaving the big firm. The real risk is staying so long that you forget how to build something from scratch. Step by step, to prepare for the 2027 to 2030 shift, you should do 3 things starting today. First, diversify your technical base. If you are in banking, learn the operational metrics of FP&A. If you are in wealth management, learn the risk mitigation frameworks of the compliance department. The T-shaped professional, someone with deep expertise in one area but broad knowledge across others, is the only one who can navigate a shifting economy. Second, formalize your network. Don't just have LinkedIn connections. Have a personal board of directors, 5 people you trust who are 5 to 10 years ahead of you, and can provide cold-eyed advice when you are at a crossroads. Third, build a public track record. In 2026, your reputation is your most liquid asset. Whether it is through a specialized newsletter, a series of white papers on market trends, or a public portfolio of successful advice, you need verifiable social proof that you know what you are talking about. Consider the case study of a fintech analyst who anticipates the 2028 regulatory shift in digital payments. Because they spent 2 years writing about the intersection of stablecoins and Federal Reserve policy, they are headhunted to lead a multi-billion-dollar joint venture between a tech giant and a legacy bank. They didn't just get lucky. They manufactured luck by being the most visible expert at the exact moment the market needed that expertise. The United States financial system is the most complex, high-stakes, and rewarding game on the planet. For a beginner in 2026, the opportunities are not guaranteed, but the historical trends suggest that for those who master the technical, the equity, and the social protocols, the potential outcomes are limited only by their own ambition. You have the masterclass. You have the roadmap. You have the 5 specific paths that are currently in the highest demand. But there is one final open loop. Throughout this deep dive, we have focused on the U.S. domestic landscape. But in 2026, the dollar is undergoing its most significant challenge in a century, and cross-border capital flows are being redefined by new geopolitical alliances. There is a hidden sector of finance that we haven't even touched yet, a sector that operates in the interstellar space between nations, where the rules of traditional banking don't apply, and where the next generation of sovereign wealth is being created. If you thought the top 5 careers we discussed today were high stakes, you haven't seen anything yet. There is a specific role emerging in the global south and emerging markets that is currently being filled by American finance refugees, people who took their Wall Street training and applied it to the new world order of 2027. If you want to know how to position yourself for the global pivot, and how to build a career that is truly post-national, you need to understand the shadow capital markets. But that is a masterclass for another time. For today, your mission is simple. Pick your path among the 5, master the technicals, map your network, and start climbing the equity ladder. The 2030 economy is coming, and it belongs to the prepared.